Did you know that 70% of lottery winners end up broke within a few years? Or that 45% of Americans have no money saved for retirement? These shocking facts show why understanding money management is crucial. But don't worry, there's hope. In Money, Master the Game, Tony Robbins reveals powerful investment secrets. He's interviewed top investors, learning their best strategies. Imagine having access to that wisdom. In this video, we'll uncover Tony's top techniques. You'll learn how to master your emotions in investing, harness the power of compounding, diversify like a pro, and more. Each chapter is packed with practical tips and real-life examples. Whether you're new to investing or looking to up your game, Tony's insights can guide you. Get ready to transform your financial future with Tony Robbins' tried and true methods. Let's dive in and unlock the secrets to smart, successful investing. One mind over money. Tony Robbins' rules for emotional investing. When it comes to investing, Tony Robbins often emphasizes that your mindset can significantly influence your financial success. Success in investing does not correlate with IQ. What you need is the temperament to control the urges that get other people into trouble in investing, says Robbins. This highlights not just the need for intelligence, but the crucial role of emotional control. Many investors fall prey to their emotions, which can lead to hasty decisions during market volatility. Robbins advises to stand firm when your emotions scream at you to do the opposite. One interesting statistic underscores this. A study found that investors who frequently adjusted their portfolios based on market movements typically saw a 1.5% to 2% decrease in annual returns compared to those who stuck with a long-term strategy. Robbins suggests practicing mindfulness and stress reduction techniques to improve decision-making. By staying calm and collected, you can avoid common pitfalls like panic selling or overenthusiastic buying. It's not just about making smart choices, it's about avoiding the dumb ones that can be costly. Robbins points out that the more you learn to control your emotions, the more you can command your finances. Setting clear investment goals and a strategy to achieve them is also key. Robbins encourages defining your financial goals in concrete terms and revisiting them regularly. This tactic helps keep the emotional aspect of investing in check, allowing logic to drive your actions rather than fear or greed. In this journey, Robbins also stresses the importance of education. Understanding the basics of the stock market, the nature of stocks and bonds, and the principles of risk and return can empower you greatly. As Robbins puts it, invest in yourself as much as you invest in your portfolio. To the power of compounding, Tony's time-tested strategy. Tony Robbins often talks about the power of compounding as the eighth wonder of the world. He believes that compounding can turn modest savings into vast wealth over time. For instance, if you invest $10,000 at an annual interest rate of 7%, compounded annually, in 30 years, you'll have nearly $76,000 without adding another dime. The beauty lies in the earnings on your earnings over time. Compounding works best when you start early. Robbins cites an example where one person starts investing at age 20, putting away $3,000 annually at a 7% growth rate, and stops at age 30. Another starts at age 30 and invests the same amount annually until retirement at age 65. Surprisingly, the first person, with only 10 years of contributions, ends up with more money than the second, who saved for 35 years. This demonstrates the profound impact of starting early. Robbins also advises on choosing the right investment vehicles. Index funds, for instance, are a favorite of his due to their broad market exposure and lower fees. Over time, these savings on fees can add up significantly, enhancing the compounding effect. Additionally, Robbins underscores the importance of reinvesting dividends, a method often overlooked by novice investors. This can dramatically accelerate the growth of your investment portfolio. As Robbins puts it, reinvesting dividends is like adding yeast to dough. It helps your investments rise. Lastly, patience is paramount. Robbins reminds us that wealth creation is a marathon, not a sprint. Discipline is the key ingredient. He encourages investors to keep a long-term perspective and to avoid the temptation of jumping in and out of the market, which can erode potential gains. 3. Diversify or die. Building a bulletproof portfolio. Tony Robbins often champions the strategy of diversification to safeguard your investments. Diversification is your buddy, Robbins has said, stressing that spreading your investments can significantly reduce risks. By not putting all your eggs in one basket, you can avoid catastrophic financial losses if one sector or investment underperforms. An interesting point Robbins makes is that true diversification isn't just about investing in multiple stocks. It's about spreading your investments across different asset classes such as bonds, real estate, and even international markets. This approach helps balance the portfolio's performance, as different assets react differently to the same economic events. For example, during economic downturns, bonds typically perform better than stocks. By having a mix in your portfolio, you can mitigate the losses that a stock market downturn might bring. Statistics show that portfolios that include a mix of stocks and bonds have significantly less volatility and better returns over long periods compared to those invested solely in stocks. Robbins also advises considering newer asset classes like real estate investment trusts, REITs, and commodities to further diversify. Each of these asset types comes with its own set of risks and opportunities, making them valuable additions to a well-rounded investment portfolio. Furthermore, Robbins highlights the importance of periodic portfolio rebalancing. He suggests reviewing your investment mix at least annually to ensure it still aligns with your long-term financial goals. This might mean buying or selling assets to maintain your desired level of risk. For the Billionaire's Playbook, Tony's insights from top investors. In his discussions with some of the world's most successful investors, Tony Robbins has gleaned profound insights that can be transformative. One core piece of wisdom is the importance of not just following trends, but understanding the fundamentals of investments. The road to success is paved with information, not intuition, as Robbins puts it. He recounts the advice of billionaires who insist on the importance of doing your homework before investing. These top investors spend countless hours researching market trends, economic indicators, and the financial health of companies before making investment decisions. An interesting statistic that Robbins shares is that many successful investors read extensively, some up to 500 pages a day. This habit of continuous learning helps them spot opportunities and trends before others do, giving them a competitive edge in the marketplace. Robbins also stresses the importance of patience and a long-term view, which is a common thread among top investors. Warren Buffett, whom Robbins often cites, famously said, "Our favorite holding period is forever." This perspective encourages investors to think of investment as a long-term growth process rather than a quick profit-making venture. Lastly, Robbins discusses risk management strategies used by billionaires. These include setting stop-loss orders to prevent significant losses and using hedging techniques to offset potential losses in one area with gains in another. This kind of strategic planning allows investors to preserve capital and stay in the game longer. 5. Risk management. Tony's techniques to safeguard your investments. Tony Robbins often stresses that managing risk is just as crucial as seeking returns. It's not about the money you make, but the money you keep, Robbins asserts. This principle is vital for every investor to understand, especially in volatile markets. One key strategy Robbins advocates is the use of asset allocation to manage risk. By distributing investments across various asset classes, such as stocks, bonds, and real estate, investors can protect themselves against significant losses in any single area. This diversification helps balance the risk across your portfolio. Robbins points out that historical data supports the value of asset allocation. For instance, during the 2008 financial crisis, while stocks plummeted, bonds and certain commodities like gold performed relatively well. This balance allowed investors with diversified portfolios to weather the storm better than those heavily invested in stocks alone. Another risk management tactic Robbins recommends is setting clear loss thresholds. This means deciding in advance how much loss you're willing to tolerate before you divest. This strategy prevents emotional decision-making in times of market stress and helps maintain a long-term perspective. Robbins also encourages the use of automatic rebalancing tools offered by many investment platforms. These tools automatically adjust your portfolio to keep it in line with your original risk profile, ensuring that any overperformances in one area don't lead your portfolio to become riskier than you can handle. 6. Beyond the stock market. Alternative investments Tony swears by. While stocks and bonds are the bread and butter of many investment portfolios, Tony Robbins is a proponent of looking beyond these traditional assets. To truly diversify, you need to look outside the stock market, Robbins advises. This strategy can uncover opportunities that others might miss and provide additional layers of security against market volatility. One alternative investment Robbins often highlights is real estate. Investing in property can provide a steady income stream through rentals and potential appreciation in value over time. Real estate tends to be less correlated with the fluctuations of the stock market, providing a stabilizing effect on an investment portfolio. Robbins also points to private equity and venture capital as viable alternatives for those who can handle more risk. These investments involve funding startups or private companies that have the potential for high growth. While riskier, they can offer substantial returns, significantly impacting an investor's overall portfolio performance. Moreover, commodities like gold and silver are also recommended by Robbins. These assets often perform well during times of economic uncertainty and can act as a hedge against inflation. During periods when inflation rises, commodities tend to increase in value, providing a buffer for investors. Lastly, Robbins suggests looking into more modern investments like cryptocurrencies. Although highly volatile, cryptocurrencies represent a frontier in investment that can potentially yield high returns. Robbins emphasizes the importance of education and caution when entering this market, advising investors to allocate only a small portion of their portfolio to such high-risk assets.